Hello, my name is Mudit Pandey and I'm from Pandey Property Wallah. First of all, I'll try to give best of my advice to all the investors in which market to invest into when it comes to the real estate in the international segment. But obviously, I'm a human being and I can always make go-ups and I can always make mistakes. So do a lot of research of your own also before going ahead. And this video is going to be a big one because I'm going to three major markets. I'm going to compare three major markets for you. One is real estate. So I'm going to compare three major markets for you. Number one is Dubai. Number two is UK, where I've spent close to 7 years after my education, and number three is South Asia. So investors are actually at the moment confused where to invest into, but into the real estate market. But be assured, when any market goes down, it does recover. So if your basic of your decision making is fear, you have to gain some knowledge in order to eliminate that fear. So when we talk about Dubai or Dubai versus the other markets, everyone I look into right now, investors are confused. Dubai is down from its peak. Headlines are screaming crash, then another headline says at the same time that Dubai always recovers. So that's quite true. I believe in recovery because I've seen a lot of time the share market doing the so, a lot of shares doing the so. So why it's not possible in the real estate market? And if not Dubai right now, then where? UK, Southeast Asia, or just your bank? Bank can be one of the safest area where you can still earn good amount of money, but there is not any appreciation in the money like the property does for you. So that's the difference when it comes to investing in real estate versus traditional FDs. Most of the investors that are coming to me asking these questions, and the question itself is wrong because it's coming out of fear. It's coming out of panic in the market right now because of the war situation that is happening or the geopolitical situation that is happening around the world. But do remember, we never have to take our decision on the basis of emotions. We have to take our decision on the basis of what the data says. And Dubai is 40% down from its peak. I know that's uncomfortable to hear for a lot of people. And when nearly 1 lakh new units are also going to launch between now and 2029. In between this geopolitical, as I said, the geopolitical tensions are real. And yet some of the smartest investors I know are still looking at Dubai. The reason being obviously, if you get something at a bargain price, it is never being a better chance to invest when it comes to a market like Dubai. So how is that possible? Because the question is never which market is going to go up. The question is which market is right for your portfolio. Which market is right as per your condition. So obviously for that we need to discuss with me individually, for which you can always DM me. But at the moment I'm going to drive this video through some data, and through that data we're going to decide which three market is going to get better soon. The reason being, I've got good experience of navigating this through fear is because I was in the international education, as I keep on saying, and I know the way to navigate that fear of buying something which is physically non-seen to you. So the same happens when you buy an international property. It's not seen to you. It's not visible to you. You buying it from looking at the brochure, just like a student make a decision looking at the brochure or the videos on the YouTube, or people like me who's sitting on the ground, who have been to that place and sharing the experience of that place. So I'm Mudit Pandey from Pandey Property Wallah. Let's be honest, everybody has an opinion right now. Dubai agent says buy Dubai, UK broker says buy UK, and then internet. The internet says everything, which means Inter says nothing. Internet says nothing. So if somebody is saying everything, it says nothing. So the real estate world is filled with conflicting advice, and the very real risk of making an expensive mistake is higher today than it has been in years because of the geopolitical condition in the last few months. Because in 2024 and 2025, the global market moved fast. Valuation is stressed, off-plan supply surged, and now in 2026, there is genuine reckoning happening in the multiple market at the same time. So before picking any winner, I'll have to evaluate them over a framework. and I have to evaluate every market to let you know that as per me, which is the winner, because the framework is what driven me towards the conclusion, the pedagogy or the methodology that I'm using it. So I said it, Mudit's 4 pillars. Okay, this is just a name to highlight myself. Nothing more than that. So the first pillar is we apply hardcore data-driven research before recommending any thing. It may be university, it may be any property. So here are the 4 pillars scores that every market has to go through. Pillar 1 is capital growth. This is everybody knows about. Is the value of the asset going up over a 5 to 10 years of horizon? Not this quarter, not this year. This is very important to hear. 5 to 10 years. That is what you are looking at if you're looking at a capital growth. And then pillar 2 is rental yield. Obviously, if you buy a property, you always look towards the rental yield, because rental is what you are looking forward to if you're buying a property. You just not look for the capital growth. You're looking for a rental which is an additional to the capital growth. Pillar 3 is entry risk. Obviously, this is very, very important. What is the developer's track record, which we have spoken to about in our previous video, that everybody should go through the RERA website and check the deliverables of the builders that they are putting their stake on. Pillar 4, geopolitical stability. This is a very uncomfortable thing that we have to discuss this point as well while investing. But our philosophy is simple. We will never tell you what you want to hear. We will tell you need to hear. So obviously we are not here to make you comfortable. We are here to make you understand which market is right for you. And now let's run through all these 3 markets through these 4 pillars we spoken to about: the United Kingdom, the Dubai, and the Southeast Asia. So market 1, we'll start with Dubai, our favorite, my favorite. Okay, so when we talk about Dubai, the capital growth is complicated at the moment. The data shows prices are down from their 2024 peak in several segments. Nearly 1 lakh units new are entering between now and 2029. In areas with high off-plan concentration, you should face a 50 to 25% correction before recovery. So that is the major point. When you buy any share in an order, the share market does goes up unintentionally, and then the correction happens, and then the recovery happens. So the same logic is getting applied here. As per my opinion, is going to get corrected 15 to 25% before the recovery start. But here is the truth: Dubai has never been one market. It's a major market layered on top of each other. Palm, Jumeirah and GVC are not the same market. Luxury villa communities and investor heavy apartments towers are not the same market. Capital growth potential in 2026 depends entirely on which segment you are in. And this is also very important. On which segment are you investing into? Rental yield. This is still one of the Dubai's strongest card. Even with supply pressure, gross rental yield of 6 to 8% is well located properties are achievable. Net yields closer to 4.5 to 6%. This is still significantly higher than most of the mature markets. Entry risk high right now. I'm not saying it's always, but it's high right now. So we need to understand off-plan in Dubai carries real developer risk at the moment. Projects are facing delays. Developers are sitting on the unsold stock. If you are entering Dubai in 2026, you should check the RERA registration. We covered this in the detail in previous videos, so please check that for that. Geopolitical stability. Let's be honest, the regional uncertainty cannot be ignored. Foreign investor sentiments has been shaken. 70% of Dubai transaction are currently under 2.2 million dirhams, which tells you the high-end international buyers has largely stepped back. The verdict on Dubai now, final. Not a no, will never be, because it is going to get recovered and it's a very bargain price at the moment. But a very conditional yes. The smart way to approach Dubai in 2026 is with ready properties, verified developers, and a minimum 5-year horizon, nothing less than that. If you are looking for a quick flip, walk away. So now, looking at the other market, UK, this is going to be a very conversational for me. Being a UK alumni, I've lived in this market for more than 7 years, and this one is personal for me. So when we talk about UK, I know the UK very well. I studied there, I lived there, I watched this market from the inside. Capital growth. The UK has one of the most resilient residential properties markets in the world. Over any 10 years of period in the last 50 years, UK properties has delivered positive capital growth. London is now seeing a post correction recovery. Manchester, Birmingham, and Nottingham are outperforming in terms of growth trajectory right now. Rental yield. This is where UK surprises most people. Not London, but the smaller cities gives you a better rental yield. London has hardly 3 to 4% to be honest, and but when it comes to the smaller cities like Birmingham, Manchester, or maybe the Nottingham, it is 6 to 7%. In fact, in Liverpool, it's close to 8% because of the student-centric market. Entry risk. This is the UK's biggest advantage. UK property law is one of the most mature and transparent framework in the world. So as a foreigner national, you can own UK property freehold. Developer regulations are strict. Legal protections are real. Compared to Dubai off-plan market right now, UK new builds carry significantly lower entry risk. Geopolitical stability. Among the most stable investment environments on the planet, and there is something most people miss. Sterling has been under pressure against a rupee. Let me show you what I mean. A property worth 3 lakh pound, 3 million pound today cost meaningfully less in rupee in terms that it would have been in 2021 at a stronger pound. Currency creates opportunity. The verdict on UK, a very strong case for 2026, especially regional cities, especially for investors who want a lower entry market risk and consistent rental yield. The UK is not flashy, it's not glamorous, but it is a smarter way to build long-term generational wealth. So now market 3, Southeast Asia, the last market. So let's talk about market. This has quietly become seriously conversational. South Asia, specifically Malaysia, Thailand and Vietnam, capital growth, emerging and trending upward. Malaysia, Kuala Lumpur has shown consistent 4 to 5% annual growth. Bangkok and Phuket in Thailand are seeing a surge driven by Chinese and European buyers repositioning their capital. Rental yield among the highest you will find in any comparable market. Thailand properties in the right location can yield you 8 to 12%, which is very, very high. Malaysian rental market is more stable. 5 to 7% is achievable with the right asset. Entry risk. This is where you must be careful. Thailand does not allow foreigners freehold land ownership. You can now own a condominium, not a house. Malaysia has a specific minimum investment threshold for foreign buyers. You must have local legal counsel. This is non-negotiable. We apply our tough vetting process to every developer before we recommend a single asset in the region. Geopolitical stability, broadly stable, but these are emerging markets. Currency risk is real. If we'll talk about currency, is real. Legal system are maturing, not mature. The verdicts on Southeast Asia, high potential, high homework required. Not for the first time international investor, for experienced investor looking to diversify away from single market exposure. This is a conversation worth having. So where does the Pandey Property Wallah see the clearest opportunity in 2026? The UK specifically, regional cities, Manchester, Birmingham, Liverpool with a strong demand. Ready properties and gross yield above 6%. Dubai selectively, ready properties only. Tier 1 developers only. Zero off-plan speculations. Southeast Asia for investors ready for 7 to 10 years horizon and have the appetite for the emerging market play, not for the novice. But here is the single biggest thing I want to take away from this video. The question is not which market is best. The question is which market is best for your profile, your timeline and your risk tolerance. That is exactly where we come in, because we are here to find assets in high growth areas that offers the best possible returns for you specifically, and we do that the smart way. If this framework has helped you see the international real estate market differently, please subscribe. Because every week we apply the same framework to different international markets and specific opportunities along with specific developers. So you can invest more confidently with data-driven research. I have one question for you. Out of these three markets, which is the one you are looking forward to invest into? Please put a comment on it and I will be more than happy to see that and help you around. Welcome to Pandey Property Wallah. Let's build together. Thank you.